All right, folks, welcome to the Public Podcast. I'm your host today, JD Durkin, here with you to discuss minimum wage hikes and its impact on inflation. Feel free, as always, of course, to check us out on Spotify at the Public Podcast and, of course, over at YouTube at Public Invest for more in-depth interviews to help keep your portfolio on track. Today, we are joined for a one-on-one conversation with LanceRoberts, the Chief Strategist at RIA Advisors. Lance, thank you for being here.
Glad to be here.
Nice to have you. So let's talk about this, a really important issue. At the end of 2021, Lance, there were about 2 million or so workers in the United States who are working at or below the U.S. minimum wage. Give us some insight, a bit of context or perspective into the size of the minimum wage working class compared to, let's say, the overall U.S. economy.
Right. So first of all, let's just start out and say this is not a political conversation that we're having here. So what we're going to discuss here is not should we have a minimum wage or should we raise the minimum wage? That's not the point of the conversation. The point of the conversation, though, is when we're talking about instituting a policy to raise minimum wage, what many have missed in the financial markets and economic side of it is the overall impact that can have to both economic growth, inflation, and the market. So I just want to set that out up front so we don't get too far off on people saying it's a political argument because it has nothing to do with that. But when you take a look at the number of people on minimum wage today, as it is, we are near some of the lowest levels in history of the actual percentage or the number of actual people on minimum wage compared to the workforce. We have about 190 million people in some various form of the workforce, and we have about 2.2 to 2.5 million, depending on the numbers, that actually make minimum wage. And so, when you start to look at this, the minimum wage seems like a big issue in this country. But in fact, and here's a little interesting tidbit for you. If you make $30,000 a year in the U.S., you're in the top 1% of income earners worldwide. So don't you feel better already?
What does the demographic of minimum wage workers consist of, and including with your last point there? And that's welcome perspective because I don't know how many people really know to look at it like that.
Yeah. So, look, I have 4 kids and I have a requirement in my household that when they turn 16, they have to get a job. They have to pay for their own car. They have to pay for their own insurance, gas, those type of things. So and the purpose is to teach them life skills so that they are better prepared when they go out into the world. It's also to get them to learn that, having an education and not being forced to work in a fast food drive-through, there is an alternative, right? So minimum wage jobs are primarily found in the fast food industry, not surprising, leisure, hospitality, and healthcare, some of the lower wage paying areas of the economy. That is also where you find the fastest growth in jobs since the pandemic has been in that area as well. But most of those pay minimum wage. Now, and the important thing is that most of these jobs are starter positions. When we talk about minimum wage, one of the things that gets thrown up a lot is, well, it's not a living wage. It's not meant to be a living wage. Minimum wage is designed so that the employer and the employee have a test ground for each other. As an employer, it's extremely expensive to hire an employee. So if I hire somebody at $30,000 a year as an example, I also have to pay payroll taxes, healthcare expenses, 401k plan contributions. I have to provide the office space, the computer, all the other stuff. So when an employer hires somebody, and not to mention the training time, it's very expensive to put that person to work. So minimum wage allows both the employer and the employee to have a test ground to where the employee can learn how to work with others, how to take direction. And if they do a good job, they're very quickly going to be moved up the pay scale. And that's why there's not that many people in that minimum wage area. Minimum wage was never designed to be a living wage. It's a starter ground for the employee to form a base of operations from.
So obviously, I think people will look at this conversation or even to your last response and say, well, how can you, obviously it's not maybe a bit of a living wage, but how many minimum wage jobs does someone who's starting out maybe in his or her working career need to have to be able to pay the basic bills? I mean, how do you sort of square the circle of, or sort of square the conversation that of the point that you just had with the fact that you do have a lot of people that may need to take some of these jobs, but still have a difficult time kind of making ends meet?
No, look, there's no easy answer to that. And look, in any economic system in the world, whether it's socialism, communism, fascism, capitalism, it doesn't matter. There's always going to be a bell curve of people that are at the very low end of the scale, and at the other end, you got some very, very wealthy people, and then most of the people survive somewhere in the middle of that. And that's just how economics work. So when somebody is at that low minimum wage paying scale, and again, most of those are college kids. Go to a restaurant and look at the people, those little smiling faces behind the counters at McDonald's or whatever. They are generally very young individuals, and they're working in college, they're in high school, they are trying to work their way through, trying to get in college, et cetera, coming out of college. Those are not meant to be long-term jobs. You're supposed to take that job, quickly learn a skill set, and then move up the ladder very quickly. So the point is that here's a real tough statement I'm going to make, and people need to think about this too before you make just an immediate assumption. Your minimum wage is actually zero. And what I mean by that is that when you go to an employer, your salary, your wage, what you're being paid is based upon your skill set. So if you don't have a skill set of some sort, your minimum wage is going to be very low or zero because you won't be able to get a job. If you develop a skill set, your wage is going to rise per that skill set of whatever you make. And this is why the vast majority of people make above minimum wage. Again, 2 to 2.3 million people make minimum wage. Vast majority of people make very much more of that. And that's because their minimum wage is higher because of their skill set. So if you're locked in that minimum wage and you can't get out of it, the problem may be more you than it is the actual company. And I know that's not what people want to hear, right?
Sure. No, absolutely. And I appreciate the context. To the point about the opening question I asked you, people do hear statistics that say there's still some percentage of individuals in the American workforce who make below minimum wage. Can you just kind of walk me through? Someone may hear that and say, how does that even happen? Is that legal? Is this a state by state sort of thing? What should we know about people who might actually come underneath that, or what the potential extenuating circumstances might be towards those situations?
Sure. Well, so a lot of it is state by state. For instance, California has a minimum wage that's much higher than Texas. So if you're saying the minimum wage is $15 an hour nationwide, then yes, there are some states that pay below minimum wage. But how do people actually wind up making below the state's minimum wage? Well, for instance, servers, as a good example of this. They make $2 an hour plus tips. So if they're working in a job to where they're getting their $2 an hour and they're not getting that many tips for one reason or another, it could be the restaurant, could be the location, could be a variety of issues, they could theoretically make below the minimum wage because of that location. Of course, whose responsibility is there? Look, some of the areas, I've been in restaurants where nobody's there, right? So, you have to, that's where the employee has to make the decision, hey, I'm going to leave and take my skill set of being a server, and I'm going to go to a different restaurant. And we've seen a lot of that during the pandemic.
And as a former server myself, and I was a bartender, there were definitely times, granted it was a market like New York City, there were certainly times I would make above that level. And there are certainly nights or weeks or slower business cycles where, yeah, to your point, if you were to kind of break it down along the average hourly take home, might actually end up being below that. So I do appreciate that context. We were just talking about the state by state differences here, right? And an effort from some places like my home state of New Jersey, the Commonwealth of Massachusetts, Connecticut, to sort of bump that minimum wage number up. Some states have it around $15 an hour, like you just mentioned there. How do you typically see companies react if they operate in a state where government officials, could be in either party, are looking to push that number a bit higher?
Well, and look, again, this isn't a political statement. So, what we're talking about here is just it is what it is. Here's the problem with bumping the minimum wage to $15 an hour. So let's say, for instance, and look, you and I were both servers, during our younger years. So we've both been in that business, and we both have waited tables and done all those type of things. And it's terrible work. I don't wish it on anybody. But what happens is that, they raise my wage as a server to $15 an hour. The host of the restaurant, that is the next promotion level for me. I'm making some things up here, but just as an example, So the next rung up the ladder, if I'm going to get promoted from being a server to the next level up, it would be the host or the hostess position of that restaurant. So that position was already paying $15 an hour. So now that position requires a wage increase to say $20 an hour. But now the bartender who's now working behind there, that was the next step up. So he's at 20 going, hey, wait a second, I need to be made more. So we have to raise his wage. And it goes all the way up the ladder. And this is the one thing that people haven't really thought about is the consequence of raising that minimum wage. Because the person that's next up in that ladder, as soon as that minimum wage rises to his level or her level, they're either going to say, either pay me more or I'm going to find a job where I have to work less and make more money. And those jobs are out there. Think about people that deliver packages as a good example. That's very intensive labor. You read the job description for that, have to lift up to 100 pounds and you're getting paid $15 an hour. Well, at $15 an hour, I can probably go find something else that pays the same amount and I don't have to lift 100-pound packages. So it causes wage inflation and raises the cost of operations. Now, here's the part that people miss. For any company that's in operations, whether it's a restaurant, it's a Subway franchise, it's a packing company, it's a UPS shipping location, whatever it is, those are franchises or businesses. The number one cost to every business is employees because, again, it's not just what I pay them. I also have to pay the taxes on their payroll. I have to pay their health care. I have to give them benefits of some sort. I have to pay for their time off. All the costs to running my business. Well, that's a cost right at the top line. I make $1, 50 cents of it goes to payroll, and I have 50 cents left over for all my other expenses. And then I still, as a business owner, have to get paid. So after all these other expenses, so when I raise that cost at the minimum wage, I've now impacted that business. So as a business owner, and look, this isn't my statement. This is from the Manhattan Institute. This is from the Congressional Budget Office. Numerous research websites as well all say the same thing, that the first operation of a business is either to stop hiring people when you raise the minimum wage, automate, or create other opportunities that reduce the amount of labor required to operate that business because it is so incredibly expensive to hire people in the first place. But when you raise that minimum wage, it's the impact of the overall profitability that has to be maintained. And a good example of this, when California raised their minimum wage to $22 an hour, McDonald's responded by creating a fully automated restaurant. No employees whatsoever.
I wonder what the impact is on the overall economy, right? On the one hand, I think you just did a great job at laying out a lot of the challenges from the, let's say, kind of corporate or managerial element. Maybe some would argue, on the other hand, if you were to increase the minimum wage, there could be a boost to parts of the economy because you are then incentivizing those workers to then have more take-home pay who can then turn around and spend more money into other parts of the economy. So, I mean, what's your sense on terms of what that balance looks like if an overall minimum wage were to be raised to, let's say, $15 an hour? What does that big picture impact look like, you think, Lance?
Okay, so we're talking about impacting the 2.5 million jobs at the lower end of the scale, right? So we're going to raise those minimum wages. The impact to the economy is going to be actually nil or negative. And the reason is twofold. One is that, again, as I increase those wages at my minimum wage level, I'm either A, going to hire less of those workers because I can pay my other workers that already have the same amount of money and then automate those lower wage paying jobs that were there to start with. Because now I'm measuring the cost between that employee cost, which is permanent, and every year I've got to pay that $15 an hour versus automating that job. And I have a one-time expense of automating that position, then those expenses go away. So there's really no evidence that raising minimum wage actually increases better economic output other than it potentially reduces jobs through automation. It does make companies more profitable when they move towards automation. This is why we've seen a big leg up towards that. And of course, now the big concern is artificial intelligence and what that's going to mean in terms of future productivity for businesses and how they can automate things even more. We're going to see those impacts. But we can see from economic growth that all those theories have not really played out because going back to 1980, there's been one directional trend of economic growth, which has been lower economic growth due to increased debts and deficits. And I'm not talking about just the government. I'm talking about household balance sheets as well. As we've gone through this, we've lowered interest rates to zero. We keep having declining interest rates, which means that people are living beyond their means, taking on more debt. And that debt has to be maintained at lower interest rates. Lower interest rates mean lower inflation and lower economic growth. So there's no evidence that increasing minimum wages or anything else increases economic prosperity.
And to the point of AI, of course, you don't have to pay ChatGPT $7.25 an hour or $15 an hour or anything like that. You mentioned some of the bigger macroeconomic, let's call them headwinds here. And I wonder how an increase in the minimum wage you think or suspect might impact the goals of the central bank in terms of the long horizons of Chairman Powell and his colleagues at the Fed in terms of employment. What does this mean for the efforts of the Fed, especially in a current high interest rate environment?
Well, this is one of the big fears of the Federal Reserve, and this is a function that can be created again by increasing the minimum wage, is what's called a wage price spiral. And what the Fed's biggest fear, when we start talking about inflation, again, what's the biggest driver of inflation? And when you talk about when businesses have to pass on costs, that's inflation, right? Businesses are passing on costs to consumers. That means the stuff you buy at the store goes up in price. And that's because businesses are having to charge you more in order to produce that. So if I raise wages, again, that's the biggest component of my expense ratio as a business. That's where my profits are eaten into. I've got to raise my cost. So that's inflation. I've got to pass that wage increase on to consumers through inflation. McDonald's just recently talking about consumers are starting to balk at $9 for a McDonald's hamburger. That's inflation getting passed on because their costs have risen, whether it's input costs, labor costs, et cetera. So the Fed's big concern is to get inflation down to their 2% target rate, which, by the way, if inflation is at 2%, economic growth is going to be at or below 2% because those two have a very high historical correlation. Interest rates will also come down to 2% or less. So all of this is going to be driven down to a lower level, and that is also weaker economic growth and weaker prosperity to get there. But that's the only place that we can be where we can sustain $31 trillion in government debt, interest expenses to go along with that, a tremendous amount of debt in households, et cetera, is all dependent. 30% of the Russell 2000 are dependent upon low interest rates to stay in business and fund their business through debt. So there's real consequences to having very high inflation, and raising minimum wages right now creates that accelerated kind of escalator in wages all across the board and makes inflation stickier than it would have been otherwise.
And we know that below trend growth has certainly been one of those very clearly and publicly communicated goals of Chairman Powell and his colleagues at the Fed, as we've been following along with all those FOMC decisions now for more than a year, since March of last year. Should investors be worried, you think, Lance, about seeing an inflationary impact over the near future, or maybe a bit of a threat for a longer term projection?
And I don't think inflation is really going to be a problem long term. Disinflation is already starting right now. Deflation is going to be a bigger risk probably as we move into the next couple of years out. Again, as economic growth starts trending back towards that sub 2% level, that's the reason that economic growth is going to trend to that level is because of slower activity within the economy, which is also going to bring down, that's disinflationary nature, will bring down inflationary costs. I think the bigger threat for the Fed, and again, this is, the wages that we're talking about is just one problem, potentially making near-term inflation stickier. In other words, it doesn't go down as fast as the Fed would like, which means they have to keep interest rates higher for longer. But that has an impact upon consumer stability because of the amount of debt, credit card payment, interest payments, mortgage payments, those type of things. And it has just a very broad impact on the economy, from housing to used cars to consumer spending, et cetera, all across the consumer paradigm.
Lance Roberts, Chief Strategist at RIA Advisors. Lance, thank you for the context and perspective. It was a great conversation. Appreciate you being here with us today.
My pleasure. Thank you so much.